All right, if you're heading into a career in finance or consulting, you're going to hear this term thrown around a lot, structured products. Now, they have this reputation for being super complex, and honestly, for good reason. But here's the thing, you can't ignore them. So think of this as your personal, high-level briefing. Everything you need to know to nail that interview and really understand the hidden dangers for wealthy clients.
So here's our game plan. First, we're going to unpack the puzzle that these products are built to solve. Then, we'll actually build one from scratch, take a spin through the different models available, and, most importantly, we're going to pop the hood and check for all the risks. Then, we'll finish up with a final briefing so you're ready for any question they can throw at you.
Okay, so why do these things even exist? It really all comes down to the unique problems that high net worth individuals, or HNIs, are trying to solve. You know, a standard mutual fund or an ETF, that's made for the masses. But when you've got millions or tens of millions, your goals get way more specific. You need something custom-built, not a one-size-fits-all solution off the rack. I mean, just think about it for a second. You have a tech founder who wants aggressive, super tax-efficient growth. And then you have someone who's inheriting wealth from 5 generations back. They're all about preserving that capital for their kids and grandkids. Their appetite for risk, their timelines, they are just worlds apart. The same investment playbook? No way. It just won't work. And that's exactly the puzzle structured products are supposed to solve.
So how do you actually build one of these custom solutions? Let's imagine a structured product is like a custom-built financial vehicle. You're not just walking into a dealership and buying a standard car. No, you're commissioning one, built to your exact specifications. So let's pop the hood and see what this thing is really made of.
At its very heart, a structured product is a hybrid. It's a mashup. It takes 2 totally different parts and bolts them together. A safe, predictable piece like a bond, and then a speculative, high-octane piece, the derivative. And it's this unique combination that allows it to be tweaked and tailored for so many different goals.
Sticking with our car analogy, let's assemble this thing. The bond component, that's like the chassis of the car. It's the foundation. It provides the safety, and its main job is to get your initial investment back to you. Then you've got the derivative. That's the engine. See, the interest you would have normally gotten from the bond, that gets used to buy this engine, and this is where all the potential for high returns comes from. And finally, the underlying asset. That could be a stock index, a commodity, whatever. That's the road. The performance of your engine depends completely on where that road goes.
And you know, just like with cars, there isn't just one model. There's a whole showroom of different options. Once you get how the core parts work, you can see how they can be put together in almost countless ways to get different results. Let's take a quick look at some of the most common types you'll see.
So each of these models is built for a different kind of driver, right? You've got the Principal Protected Note, or PPN. That's like a safe, reliable sedan. Its whole goal is capital preservation, perfect for that conservative inheritor we talked about. But look closer. The risk isn't zero. See that? It says issuer credit risk. We're going to circle back to that in a big way. Then you've got the Yield Enhancement Note. That's more like a sports car for a risk-tolerant investor who's chasing high income. And finally, the Auto-Callable, which dangles a really juicy coupon but comes with its own unique set of trade-offs.
Let's zoom in on one of the most popular models on the lot, the Auto-Callable Note. It's a huge favorite because it offers a very, very attractive income stream. But just like any high-performance vehicle, you really need to understand how it handles before you get behind the wheel. There's always a catch.
Here's the basic idea. The note pays you a high, regular coupon. That's your income. But there's a big condition. On certain dates, if the underlying asset, let's just say it's the S&P 500, is above a preset level, the note is automatically called. That means the ride's over. The deal is done, you get your original investment back, and that nice income stream just stops.
And that call feature? Well, that brings us right to the first big risk, reinvestment risk. Think about it. The note gets called when the market is doing well. So now you've got all your cash back, but you have to put it to work again when stock prices are high and yields are probably much lower. Not ideal. Second, your upside is capped. If the S&P 500 suddenly rips up 30%, you don't get any of that. You just get your fixed coupon. And finally, and this is a big one, your principal is at risk. If the market tanks and falls below a certain protective barrier, you could lose a huge chunk of your initial money.
This brings us to probably the most important part of our entire briefing. As a consultant, as an advisor, your job isn't to just look at the shiny brochure. Your job is to pop the hood, get your hands dirty, and check for all the risks that are not immediately obvious.
This quote right here, this is everything.
You have to understand that a structured product is, at its core, just an IOU from the bank that created it. That promise to return your principal? That's not a government-backed guarantee like FDIC insurance. It's just a promise from a bank. And if that bank goes bust, that promise is broken, and you could lose everything, even if the stock market did exactly what you wanted it to do.
Let's put this side by side with a regular old corporate bond to really see the difference. A bond is usually liquid. You can probably sell it if you need your cash back. A structured product? It's highly illiquid. You are often locked in for the long haul. A bond's costs are pretty transparent. A structured product's fees? They're often buried deep inside all that complexity. And here's the kicker. In a bankruptcy, a bondholder has a clear claim on the company's assets. As a structured product holder, you're an unsecured creditor. You're at the very back of the line, hoping for scraps.
This quote from financial research absolutely hits the nail on the head. The complexity of these products isn't just an accident, it's almost a feature. It allows the banks to bake in all sorts of high fees for structuring, for hedging, for distribution, and these hidden costs act like a massive drag on your returns right from day one, and they mostly benefit the bank that built the product in the first place.
Okay, let's bring it all home. We've seen why these products exist, how they're built, and where the real landmines are hidden. Now for your final briefing. The key things to remember and the questions you should be ready to answer.
First, and this is critical, remember they are highly specialized tools for very specific client problems. They are not magic bullets. Second, the single biggest risk is not the market going up or down, it's credit risk. The financial health of the bank that issued the note is everything. And third, never forget that complexity always comes at a price. In the world of structured products, that price is high hidden fees and a serious lack of liquidity.
So, when you're prepping for that interview, these are the questions you need to have sharp answers for. When is a structured product actually the right tool for a client? What's the one risk you have to check before you even think about anything else? And how do you weigh that juicy yield they're promising against the reality of high fees and being locked into your investment? If you can nail these questions, it shows you don't just know the definition from a textbook. It shows you understand the strategy and the trade-offs. And that right there is what's going to set you apart.